The markets are closed. It's Sunday, February 8th, 2026. Silver last traded at 77.69 on Friday, while gold closed near 4,160 shekels. Hidden inside that spread is a reality most mainstream analysts refuse to confront. Silver has entered blue sky territory. There is no resistance above, no meaningful supply waiting to sell, no historical ceilings left to defend. For the first time in 45 years, silver has broken through every barrier that contained it, dating back to 1980. What happens next is not about whether silver moves higher, but how fast the acceleration begins and whether positioning happens before the crowd understands what's unfolding. If $77 silver feels expensive, that judgment is anchored to a market reality that no longer exists. Blue sky territory is not a buzzword or trader slang. It is a rare structural condition that appears once or twice in a generation. It means there is no overhead resistance, no prior peaks where sellers are trapped and waiting to exit, and no psychological levels where profit-taking is embedded in market memory. Resistance is memory. It represents areas where traders experienced pain and are eager to get out. In blue sky territory, that memory disappears. There is no baggage to unwind, no pain to resolve, and no sellers left who are desperate to exit. The market is trading in a zone it has never occupied for any meaningful length of time, and that fundamentally changes behavior. Silver spent 45 years building a base. From 1980 onward, every rally failed and every breakout was rejected. That ceiling held until late 2025, when it finally broke. In January 2026, silver surged through $121, shattering the psychological barrier that capped the metal for nearly half a century. Then came the crash. Price collapsed from $121 to $63.90 in less than a week. Volatility exploded, retail investors panicked, analysts declared the top, and headlines proclaimed the bubble was over. But the structure never broke. The breakout remained intact. What occurred was not a reversal, but a liquidation event that flushed leverage, triggered stops, forced margin calls, and removed weak hands from the market. Those sellers are now gone. Above current prices, there are very few participants who need to sell. Below price, support is heavy. The zone around $64 is reinforced, and the area near $55 represents a structural floor. If silver revisits those levels, buying is likely to be aggressive as investors who missed the breakout sold too early or waited for confirmation step back in. This creates an asymmetric setup where downside is limited and upside is open-ended. Historically, silver corrections of this magnitude are not unusual. In 2008, silver fell more than 60%. In 2006 and 2004, declines of nearly 40% occurred. Each of those moves felt catastrophic in real time, yet everyone was followed by new highs. The difference now is that those corrections happened below resistance, while this correction occurred after a breakout into blue sky. Corrections below resistance confirm ceilings. Corrections in blue sky do not. They simply reset positioning before the trend continues. Silver is now consolidating between roughly $64 and $90. That range is not bearish, it is constructive. Consolidation allows volatility to compress, sentiment to cool, and strong hands to accumulate. If silver fails near $90, the range may extend and frustration will grow. If it breaks above $90, the move is likely to be violent because there is little standing in the way until the $121 high, and beyond that, nothing at all. Most investors make the mistake of anchoring to past prices. They compare $77 silver to $25 silver and assume the move is over. But price is not value. Relative to stocks, bonds, and traditional portfolios, silver remains historically cheap. The ratio of silver to a 60-40 portfolio has just broken out of a multi-decade double bottom formed during the 2008 financial crisis and the 2020 pandemic. Breakouts from structures that large do not fail quickly. They mark the start of secular trends. Yes, the chart shows damage. Momentum indicators rolled over, volatility spiked, and the market needs time to repair. This is not a straight-line rally. Consolidation could last weeks or months, and price action will frustrate both bulls and bears. But probability favors continuation, not reversal. Even in a deflationary shock where silver drops sharply, history shows those moves are driven by forced liquidation, not fundamentals, and they tend to reverse quickly. The smart money understands that volatility is not risk. Permanent loss is risk. In blue sky territory, volatility increases because there are no reference points, but the structure remains bullish. Accumulation happens quietly during consolidation, not during breakouts. When this range resolves and silver clears $90, positioning will shift rapidly. The move will be fast, gaps will appear, and latecomers will be forced to chase. Blue sky breakouts are rare. Silver is in one now. The breakout remains intact, support is holding, and the next move is higher. Not tomorrow and not on a schedule, but when it comes, it will be unmistakable. The market is offering time to prepare. That time will not last.